17 years ago, I was staring at my bank account at 2 a.m., surrounded by 10 rental properties, and I was completely broke. Not just cash poor, I mean checking account in the red, credit cards maxed, and a tenant calling about their AC blowing hot air that I couldn't afford to fix. I had done everything the gurus told me to do. I was the successful real estate investor everyone looked up to, and I was about to lose everything. Here's what they don't tell you. I had over $1 million in assets on paper, but my liquidity ratio was catastrophic. I was leveraged at 85% LTV across the board with zero contingency planning for market shifts. If you think more properties equal more money, you're making the same mistake that almost destroyed me. And I'm about to show you the 5 hidden traps that are probably bleeding you dry right now, even if you don't know it yet. Every day you don't fix these problems, you're not just losing money, you're building a financial time bomb. Look at what happened to rent collections during COVID or Sunbelt market corrections. If you weren't prepared, you lost millions seemingly overnight. The first trap that almost killed me? Chasing more doors instead of real profit. I like to refer to it as going wide before going deep. I was obsessed with hitting 10, then 20, then 50 rentals. I thought the more properties I own, the richer I'll get. According to NMHC and institutional investor surveys, most multifamily operators plateau at 30 to 50 units unless they professionalize their management. Anything above that becomes a full business, not a side hustle. I learned this firsthand, the hard way. I ended up equity rich, cash poor, working more hours than my day job ever demanded. And I was lucky to get 4 hours of sleep a night. But here's the question I should have been asking. What's my true cash on cash return after factoring in my time investment? Most investors never calculate their effective hourly wage. The paradox most investors miss: more often means less freedom. Decision fatigue kicks in. You become a prisoner of your own success. You know that sick feeling when your phone rings at 11 p.m.? I mean, your heart drops because you know it's another emergency that you can't afford. I mean, face it, rarely does good news call at 11 p.m. And here's what most investors miss. They underwrite only for appreciation, ignoring true cash on cash returns. They believe passive means hands off, when pros know it just means system-based. Your spouse stops talking about vacation because every extra dollar goes to repairs. Your friends think you're rich because you own real estate, but you're eating ramen while your tenants live better than you do. And the worst part? You can't tell anyone because you're supposed to be the successful one. The reality is, scaling without infrastructure almost always leads to operational bottlenecks. You hit what I call the complexity wall, where more units actually decrease your per-door profitability. If you're thinking this doesn't apply to me, you're exactly who needs to hear this most. I've talked to over 200 investors in the past year, and 73% of them admitted they're making less per hour than they did at their day job, but they're too embarrassed to admit it publicly. The truth is, most small investors are running what I call accidental businesses. They have all the complexity of commercial real estate with none of the systems or capital structure to support it. Just last week, an investor told me, "Matt, I own 25 properties and I'm working 60 hours a week just to break even. I can't even afford to take my kids to Disney World." And here's what I asked him. What's your underlying leverage ratio? How are you adjusting your cash flow analysis for interest rate volatility? And most importantly, what's your exit strategy if the market turns? He couldn't answer a single question. That's the difference between owning real estate and being a real estate professional. And here's the curveball that almost destroyed me: underestimating true costs and cash flow killers. The conventional wisdom says keep 3 to 6 months of reserves. The truth is, that's just the starting point. Top operators stress test for 12 plus months and scenario plan for black swan events. I now use what I call the core satellite strategy. Core properties for stable cash flow, satellite properties for appreciation upside. This balances your risk profile across market cycles. Before I continue though, ask yourself, how fast can you exit in a bad market? What's your liquidity risk exposure? If you can't answer immediately, you're flying blind. Here's what I wish I would have done from day one. First, underwrite every deal at 20% haircut to market rents, assuming that I'm going to hit at least 2 black swan events in a decade. Second, stress test for 12 plus months of expenses, not 3 to 6. And then build multiple exit strategies before I buy. And then create what I call optionality buffers, cash reserves that let you pivot when opportunities arise. And there's one hidden metric even most pros overlook, and I'll reveal that in a minute. But picture this. It's 5 years from now. Scenario A. You ignored what I'm telling you today. You're managing 20 plus properties, working 60-hour weeks, your marriage is strained, and you're making less than the minimum wage per hour. Worse, you're trapped because because you can't liquidate fast enough to escape. Or scenario B, you designed for optionality. You own fewer properties but make more money, sleep through the night, and have multiple exit strategies for any market condition. True pros see real estate as a capital allocation business, not just rentals. They're constantly asking, where can I deploy capital for the highest risk-adjusted returns? What about local political risks, rent control expansions, insurance market changes? I've seen entire markets become uninvestable overnight due to regulatory shifts. The window for fixing this is closing. Every month you wait costs you thousands. I almost quit many times. I was literally drafting emails to sell everything when I discovered something that changed everything. It wasn't another property. It wasn't more money. It was shifting from thinking like a landlord to thinking like an institutional asset manager. I had to choose, run an institutional model with professional systems and scalable processes, or an entrepreneurial model where I stay small but highly profitable per door. Here's what saved me: professionalizing my operation before scaling further. Most investors think they can self-manage indefinitely. The reality, without systems, you hit an operational ceiling around 10 to 15 units. This is where complexity explodes exponentially. So here's the professional framework that I implemented. Document every process like you're franchising the business. Screen tenants using institutional grade criteria, the 3x income rule, credit score minimums, and employment verifications. Then interview property managers like you're hiring a CFO. Review their P&Ls, not just references. And monthly financial reviews with variance analysis. Treat it like running a public company. And ask yourself, if I had to sell this portfolio tomorrow, would a sophisticated buyer see professional management or amateur hour? More properties just multiplies your problems if your systems aren't institutional grade. My 10 commandments for managing property managers, it's in the document linked below. Okay, this next insight, it separates the top 1% from everyone else. Let's talk contracts and leases, but at a professional level. Here's what most people screw up. They're playing checkers while the market is playing chess. Institutional operators use 2 to 3 year leases as standard, with built-in rent escalation clauses tied to CPI. Most small investors, month-to-month chaos. And what about cap rate compression? How does that impact your expansion plans? If you bought at a 6 cap and the market's now trading at 4 caps, your exit strategy just changed dramatically. The professional approach, lease terms that protect against inflation and regulatory changes, documentation standards that would pass institutional due diligence, and payment systems that eliminate float risk, ACH only, no exceptions, and fee structures that actually get enforced consistently. I just reviewed a portfolio where the owner was losing $47,000 annually just from inconsistent late fee enforcement. That's institutional negligence. And here's a story that changed my entire approach. On my 4th property, I thought I was set. I rented it fast, nice tenants, easy money. Then the roof started leaking. But here's the real problem. I had no contingency planning, no vendor relationships, no emergency protocols. A professional would have had pre-negotiated contractor relationships, a capital expenditure reserve schedule, and multiple financing options ready to deploy. My wife had asked me, is this really worth it? And that's when I realized I was running a business like a hobby. I implemented what I call the institutional mindset shift. Every decision gets evaluated like I'm managing someone else's $100 million portfolio. That one shift, it transformed everything and revealed the hidden metric that I mentioned earlier. Return on attention, ROA. How much profit per hour of mental bandwidth does each property generate? Most investors optimize for cash flow or appreciation. Pros optimize for ROA because your attention is your scarcest resource. Don't blindly follow the gurus. They're selling you the dream of passive income when what you really need is systems-based income. Before you buy another property, ask, am I building a scalable business or just collecting more problems? And here's the thing that'll keep you up tonight. If you're smart but still not seeing results, if you know more than most but still feel like you're standing still, there's a brutal reason. And it's not your fault. You're about to see why some of the brightest people stay broke, while others with half the smarts lap them on the wealth track. And it's not about IQ, hustle, or credentials. I cover it in detail in this video right here. It's a rarely known trap that quietly keeps 90% of intelligent people from ever building real wealth. And it's probably working against you right now. I'll show you real data, embarrassing stories, and the exact step-by-step to flip the script starting today. Don't miss it. Check it out right here. Thanks for watching. I'll see you soon. Take care.